Thanks for tuning in to Talking Point today. The Talking Point today, as also a lot of this, is trying to figure out how to approach your investing in the current scenario. Could growth gain prominence while value is currently in fashion? If it is even possible to predict what growth could be, because who knows how the consumer will behave on the other side of COVID? I mean, we ended the lockdown. Who knows what will happen over the course of the next 6 months of the current calendar year? The other point is there is a bit of return to value re-rating. Can that continue further? And it's happening only in select parts. So could it happen in across the world and therefore across spheres in India? And what are the global and the local correlations when it comes to businesses? And lastly, is it only COVID-19 that is hurting India, or could there be other factors which could be long-standing in nature? Well, Samit Vartak has tried to encapsulate some or all of this in his memo that he came out with maybe 10 to 15 days ago. And we have him now today on Talking Point to try and talk about the memo, some of the findings that he has, and trying and crystal ball gaze, Samit, as to what could happen ahead. But thanks so much for taking the time out and speaking to us today.
My pleasure. My pleasure.
Okay, Samit, so let's start off with something that I noticed very interesting in your memo, and which is on the third page of the memo. There are some charts which show some of the corporate characteristics in terms of credit growth, sales growth, or those comparisons, or return on capital and those comparisons, which show that it's not just 2020 and COVID-19 which are hurting, but something else that has been kind of chipping away at the Indian corporate performance for the last few years now.
Yes, I think, what I'm trying to present is, a direct correlation of credit growth versus sales growth of corporate India. So in the first decade of this century, the credit growth used to be, close to 20%, and similar was the sales growth. So if I look at just the 5-year kind of a moving average of growth of credit versus the sales growth, they're almost exactly correlated, almost 1:1 kind of a ratio. And that growth rate, the credit growth rate, has fallen significantly over the last 5 years. So both sales growth as well as the credit growth has fallen to the 5-year average is close to 7% for both of it. So it's credit is like fuel for the economy. Without fuel, how do you run a car? So that's been a problem that we have been facing. I mean, it started probably in the 2011 time period with all those scams that came out, and during that time itself, the banking system froze. And once the new government came in, their focus has been cleaning up the banking system. And when you're trying to clean up the old mess and the bad assets, of course, it's very difficult that you see growth in the credit cycle. So I think lack of fuel is and has been the biggest problem for corporate India.
And nothing suggests that this could be getting over, right? Because banks may have the liquidity, or financial institutions may have the liquidity, but nobody's in a hurry to lend for maybe the right concerns.
Right, exactly. Because the problem is today the gross NPA before COVID itself was almost 80% of the net worth of the banking system. Now with the COVID, you don't know how much more percentage you look added to it. So we already were at 10 to 11 lakh crores as gross NPAs, and if they increase by 25-30%, you will have gross NPAs which are well above the net worth of the banking system. And in that, who has the risk aversion to lend in such kind of an environment? I mean, there would be select banks who would be lending, but that doesn't create growth overall in the economy. It will again be the select few companies who might get the funding, but that's not. I mean, that's something which is really worrying for the economy and the country. I mean, the stock market may be completely independent of this, because what happens to the stock market may be dependent on very few companies who are pretty strong, may not depend a lot on the what's the credit situation in the overall country. And that's been the case in a lot of these high quality stocks. And I hope the divergence is good for the stock market, but it's not good for the country. And I hope for the country's sake that the government is able to resolve this credit issue. I mean, it's not going to happen just by pumping some money, because I don't think we have the fiscal I think the only option is laying a red carpet for outside money, where it becomes very easy for someone to come in and acquire land. The labor law should be easy. It should be inviting enough for companies to come into India. They are not going to come just because there are issues in China. We should not be thinking, just because someone is getting out of China, we are able to attract them. We will, independently of whether China remains good, should be able to attract by competing against China or any other country in the world. And a lot of the issues like litigations for taxation and all of this, they create a lot of hurdles for a management to take a decision. I mean, they come into India and then they suddenly see that there are hurdles with respect to taxation, there is no clarity, and all of those. The ease of doing business should not just appear on paper but also practically. I mean, I think that's the only way you can attract outside capital, and we can't just depend on the domestic banking system.
Yeah, I think individual corporates have started doing that anyway, right? I mean, we've seen what's happened to Geo, notwithstanding with the Adani Group for the past 12 months.
Right.
Done a lot
Yeah.
of global capital, so the larger firms are being able to do that. Let's see if the mid-sized ones. The interesting one, Samit, though, was I mean, I was trying to get my head around, and then I'll ask you about the significance of the ROC even to the cost of funds ratio and how it is seen at the level last seen since 2002. It goes way back there, is it? So
Right.
what's the importance of this?
Yeah, so what's happening over a period of time? I'm talking about the overall corporate India. The ROC has been significantly dropping, because the capacity utilization has been dropping. At the same time, the profitability hasn't been that high. As well, the inflation has been dropping. So all of that has an impact on the return on capital. So return on capital, which used to be in the mid-teens, now has fallen to close to 8%. And then the cost of funds, which used to be close to 6%, has have gone up to 7.8%. So there is very little difference between the return on capital and cost of debt. And basically, you can think of this as internal accrual. How much economic value does a company add by generating the profits? Because you can make profits, but if they are not way above the cost of funds for you, you don't really add much of economic value. And there are two avenues of growth. Either you take outside funding or you use internal accruals for growth, and both of them are have problems. So we spoke about the banking system. So external funding for growth not available. At the same time, internal accruals also not available. So, and that's seen in the growth for the economy and the corporate India.
So then, Samit, therefore, my question then is that does the current situation as it stands give you confidence and the opportunity to buy at all? Or would you believe that looking at the issues at hand, it's better to sit on the sidelines and only venture out when the valuations are extremely mouth-watering? Because they may have been like that at 7,500 or 7,600.
Right.
They're surely not as mouth-watering as they were then. So what's your thesis as we stand right now?
Yeah, so again, there has to be a big differentiation between stock market and the economy or the corporate India and the country. So what I've been talking about in the last 5-10 minutes is more to do with the economy, the country, the corporate India. The difference in stock market is it tries to predict. A lot of things are already known to the market. What I'm talking about in terms of credit growth, lack of availability, and the lowering profits, not much internal accruals for growth, is probably a consensus knowledge. Nothing different that I'm really adding, and that's factored into a lot of stocks. I'm not saying it's factored into the entire market, because market is driven by select few stocks, and that's where even in the memo I've tried to present the divergence in the valuation of the large cap select few stocks versus the broad range of the stocks which are say below the 250 top 250 by market cap. Today, if you look at two valuation metric, one is price to earnings multiple. The top 100 median valuation, when I presented in the memo, it was 23 times. Probably it's gone up now. and then the P multiple for stocks beyond 250, the next 500 of those was 11 times. So, less than half. The same valuation in December 2017 were almost at par. So you can see that, at that time, both of the median valuations were about 30. And so that, about 30 has come down to 23 times for the top 100, and about 30 has come down to 11 times, so almost, crashed by 67%, two-third for the select or the broader range of the market. On the price to book is even deeper. The price to book for the top 100, the median is above 3 times, whereas for the stocks beyond 250, it's close to 1, so almost one-third. So the price to book is 2.5 times for the top 100 versus ones which are beyond 250. So there's that bigger divergence. So what I'm trying to say is that a lot of the issues or the risk that we are talking about may be factored into the broader market, and hence you are seeing in the last year or last few months, the small cap, the good quality small caps have significantly outperformed the overall market. I mean, we also run a small and micro cap, where you have a lot of options to pick from. In the last 1 year, when Nifty is down by 15%, that portfolio is flat. So so I think you have so much of choice to pick from, because when you're talking about the top 100, by just looking at them, you can actually ignore 50% of them. You barely have 50 companies to choose from. Whereas when you talk about the mid cap and the small cap, micro cap, you're talking about almost 600 companies that you have available to pick from, out of which, even if you throw away two-thirds of the poor quality companies, you are still left with 200 companies. And from the 200 companies, I think, it's not that difficult to pick maybe 10% of them or 15 to 20 of them, which is pretty reasonable. Whereas you only have, 50 to pick from your 20 stocks, which is, almost 40% that you generally end up picking.
The the counter, and not really a counter really, but I have a small question to that, Samit. Almost every corporate that I speak to,
Yeah.
mid-sized as well, tells me that the law of the land seems to be set towards the large company becoming larger because of the creditability, because of economies of scale, and even when foreign companies want to collaborate, size would matter. So, how do you make that distinction then, wherein corporate India believes that size will matter and the large will become larger, but whereas you are talking about maybe fishing in the pond which doesn't have as many large caps as has mid caps and small caps?
Right. So I think investors always give relevance. Businessmen do give relevance to the recency bias. Recency bias is such a strong factor for your views. If you think about 2014, when the Modi government came in, I think it was pretty broad consensus that the economy is going to do great in the next 5 years, and that was sort of built up into the stock market. And you see what happened in the next 5 years. So the expectation, the view, can be completely wrong, and most often the consensus view is wrong. So I would say, yes, today most of the businessmen, most of the investors believe that strong will become stronger. That's what the rationality of recency bias tells you, but not necessarily it will play out in the next 5 years. You don't know how it's going to play out in the next 5 years. And even considering that, even if you think that the large will become larger, I mean, the same kind of phenomenon also works in the small caps, because those are small caps because those are smaller industries. They're not the consumer oriented larger. Even there, you would find there is a bigger difference in the leader versus the rest of the competition.
Okay.
So I think that's where the opportunity is. You find such companies which are as dominant as the large caps are, and then they will definitely be the survivors, and then the weaker companies are actually getting out of they're getting bankrupt, or they just can't survive in this environment. And then these smaller companies itself are growing at much faster rate than what the dominant large cap companies are growing at.
Okay, so if I'm not wrong, when I read your memo, Samit, it seemed that the big call that you're making is that buy into companies that could see a valuation re-rating.
Yes.
If I'm correct, are you believing that in that universe, wherein it might be a small company but might be the leader of the industry that it is in, there is a higher scope for valuation re-rating?
Absolutely. I think, as I said, the universe of those beyond 250 companies, median valuation is around 11 to 12 times, which is pretty close to the crisis level kind of valuation.
But
And it's not, sorry.
But that might be for the entire space, right? I'm wondering if the
Yes.
leader of that smaller industry is also trading at that average valuation, or there the market is pricing in enough. I mean, I'm just trying to think out loud.
Yeah.
A lot of specialty
Yeah.
chemical companies might not be very large cap companies,
Right.
but valuations are still very high.
Yes. No. So I mean, again, that's where the trickiness is, that you will have to find leaders which are also trading at that valuation. You may not get it at 11, 12 times, but there are many companies which are available at 15 times or 16 times. And if those are going to grow at about 20%, it's a pretty reasonable valuation. So because see, in an investment journey, obviously you can predict the earnings growth much better than what you can predict on the valuation re-rating. So your focus has to be on the business, and then how that business is going to grow. But if you want luck in your favor, then picking the attractive value is always going to help, because I mean, you have seen many examples in the recent past where a high P multiple or a high price to book, the valuation can correct by 50% or 60% in a matter of no time. So you can't really rely on valuation sustainability, because it depends on a lot of factors which may not be sustainable. So if you have companies which are strong growth and then you get it at the lower end of the valuation, in any cycle, from the bottom of the cycle to the top of the cycle, generally the valuations are 3x re-rated, 2 to 3x. So something which is today available at 11 times at the bottom of the cycle would be available at least at 22 times to 30 times during the top of the cycle. And if you get the cycle right, I don't know whether you can get the cycle right, because timing is not something that most people can do rightly. But if you're investing for the next 5 years, there is a high probability that the 11 time multiple is going to be higher in the next 5 years than lower, which may not be the case for something which is trading at 60 times or 70 times kind of a multiple. And again, the growth there is going to be significantly lower than the leaders in the small cap space, because you probably will have a 8 to 13% kind of a growth there. So if you don't get the support of the re-rating, your returns are going to be in that range. Whereas in here, generally you find at least double the rate of earnings growth in this space if you are a good stock picker, and if your growth rate is going to be somewhere from say 18% to 22%, and addition to that, if you have some luck and then the valuations do get rated higher, as you would expect that in the next 5 years there will be at least one bull market, then you get 2x from the valuation as well as 2x from the earnings growth in the next 3 to 4 years, and you do have this 4x kind of a return. And it has happened in almost all the cycles. It happened in 2003 to 2007 cycle, where the universe itself went up by 12x. It was in the small cap. In the 2009 to 2010 cycle, within 15 months, the small cap index went up by 4x. And same thing happened in 2014 to 2017 kind of a cycle. It went up by 4x. And if you are a good stock picker, picking the right businesses where you see that the earnings will double in the next 3 to 4 years, most of the time, if you buy it in low teens valuation, their valuations will be double if the earnings are going to double in the next 3 to 4 years. But of course, it's a very difficult, it needs a lot of hard work to pick such businesses, which, and again, that's where diversification helps. If you are picking 20 businesses, I'm sure, you will not get almost all of them right. But if you get more right than wrong, you generally are set.
Okay. So you're saying that this is how you picked stocks throughout your investing career. You looked at valuation re-rating across all of these cycle points?
Yes. I mean, see,
largely.
Yes, largely, because for me, my first focus is always going to be businesses. Businesses, I look for earnings growth, which is going to double their earnings in the next 3 to 4 years. That's the rate that I look for. If I get such valuations at a reasonable, P multiples or price to book, absolutely your returns are going to be augmented by the re-rating. In the top of the cycle, generally such companies tend to fall less, not compared to maybe say HUL or Nestle, but compared to the market, they significantly fall less. So it's a generally a good strategy because earnings growth will be the biggest defense for you in most of the markets.
Got it. Okay. And Samit, one last question on this before we move to the market-wide behavior as well. But one last question on this. Are you finding companies right now where you can predict with reasonable certainty that earnings growth will grow 2x or something in the next 3-4 years? And wondering if the managements that you talk to are confident about this happening as well within their businesses. A lot of times managements at times, I mean, Ramdev tells me that at times managements don't know the beauty that they are doing, but they're actually on the path. So I'm just trying to figure that if there's a convergence of the fund managers behave thought process and the management's thought process.
Right. So yes, I mean, for growth going forward, I think it's a futile exercise to maybe depend on what the management says, because they also they are also sort of counter sentiments. Whenever the sentiments are low, their estimates for the future are going to be so pessimistic, and whenever the valuations are high, their estimates for the future are going to be way higher. So very difficult to depend. It's more, I think, prudent to just depend on your own analysis of the businesses and evaluation of the industry. Comparing that competitor with the rest of the competition to see how dominant are they and whether that dominance is going to survive. Because if they are dominant during generally the bad phase, they do get earnings growth help because a lot of the businesses go out of business.
Got
and they do get market share gain. So I think it's very difficult to predict whether you can get the doubling in most of the. But if you are diversified enough, some companies will triple the earnings in the next 3 to 4 years. Some company may not even go up by 50%. So if your framework is right, if you are competent enough to pick the right businesses, or at a portfolio level, I think you are reasonably close to what you are targeting.
Okay. What are the upside risks to market, Samit? So let's assume that you are believing that one should buy into, and there are a lot of downside risks that are known. What are the upside risks which might actually bring in your thesis faster? I think you've referred to some of these in your memo.
Right. So, what I said in the memo is that in this crisis, I generally do not take any cash call. Typically, I mean, the only cash which is in my portfolio is that if I don't find the right company, it's just cash which I keep while I'm waiting to find the right company. But this time we did take a cash call, and I believe that the tail risk. What I mean by tail risk is that it's an unknown and highly unlikely scenario playing out. The risk of that is very high, and mainly, for example, if the banking sector was to collapse, in a general downside market, markets can go down by say 20%, 30%, 40%. But if such a scenario plays out, which is again tail risk, which is beyond 3 standard deviation kind of a probability, then the downside can be extremely high. So it's very difficult to predict. I think the uncertainty of trying to know what are the scenarios which are possible is probably the highest that I have seen in my career. And because of that uncertainty, it is always, I think, prudent to take the opportunity cost, because opportunity cost is a risk by being in cash. But I think it's worth taking that risk by being in. I don't go too much in cash, but somewhere in the 20% or 25% kind of a range, it's reasonable. And then if you think going forward the risks of those extreme scenario goes up, and especially when you get such an opportunity where the markets go up just because of the liquidity, you can maybe increase the cash allocation to a certain level. So even with that, I was trying to basically note some of the factors which would be positive risk, because when everyone is negative, you don't need too many positives for the markets to run up. I mean, a month, 2 months down before this, I mean, this risk of COVID playing out, or what the banking system is going through with the moratorium, it was a pretty common consensus. Whenever almost everyone is thinking the same, generally it's factored into the prices. Then we got to think, because when you paint such a pessimistic scenario, the question is, why just 20% in cash? Why not more in cash? And from that angle, I was talking about few of the factors that if we find a vaccine, and or the economy returns very aggressively back to normal, and those kind of scenarios, if they play out, you don't need much trigger for the markets to run up. And you can see in the last month or so, there hasn't been many triggers, but irrespective of the triggers, it has played out. And one more factor which is very important is that I presented a couple of years back regarding how concentrated the market returns are. In the last, say, 40 years, there have been around 10,000 trading days. And if you rank the returns by a daily basis, and the top 100 days have given you all the returns. The Sensex is up more than 250 times, and the top 100 compounding days has given you those 250 times returns, and the remaining days have given you zero returns. The 99% of the days have given you zero returns, and you don't want to be missing out on those, because when you talk about 1%, that means in a year, if you miss out just 3 of the best days, you are generally you're given up the returns for the entire year. So all of those factors have to be kept in mind when especially you're trading at such a lower end of the valuation.
Yeah, well, maybe that's why a lot of people say that staying invested, or don't try to time the market, but time spent. I think it's a very cliched term, yes, but it's a very important one as well. Samit, just wondering, if you're so bullish on small caps, then why have you launched an alternate strategy based on large cap? Why not stick to small caps? What is this about?
Right. Yes. So see, I mean, my passion is picking stocks, irrespective of the market cap, and most of the time, the growth that I'm looking for and the valuation I look for is always, I have always found it in the smaller mid caps. So never really touched the large cap space, but still in the last 2 years, the large cap strategy of investing in extremely super quality companies, irrespective of the valuation, has outperformed what I've done. And you need 10x the efforts to find companies in this space, whereas 85% of the institutional money is all invested in the top 100 stocks. But what I believe is that it's a very efficient space. You don't really need, if I can look at the top 100 and then throw away 50% of the companies, and from the 50, if I tell 20 different investors to pick the best 20 companies, almost 75 to 80% of the companies will be common. Most of the alpha can be added in this space by a smart kind of filters, or smart formula. So there is a magic formula by Joel Greenblatt in the US, which has outperformed indices by 15-20% kind of an alpha. Even in India, we have certain formulas which have done extremely well, right? So what I said was that in this space, you don't need much effort. I don't need to spend much of a time. The only value addition I can do is, I know which are the poor quality businesses, poor quality management, which I don't want to touch. So I'll use my qualitative knowledge to throw away that. And now out of the remaining 50, we will use a formula which is back tested for the last 19 years. And in those 19 years, the annualized returns have been 23%. So why don't I launch this? Because any investor should not be paying too much for this kind of a strategy. It's a very passive strategy. And, so what I said was, if we beat the Nifty, as well as if we give you positive returns, only then we will charge you nominal fees, which is probably going to be half of what is charged by most of the mutual funds or even the PMSs. So only from that angle, it's almost like a contrast strategy to what we do, but it's an option available to investors if they're interested. I'm not investing any of my money into that, because my passion, what I believe, my time will be spent on the mid cap and the small cap.
Okay, so it's not that you believe the large caps will outperform; it's just that alternate strategy that you launched. Okay, fair call. Right. Samit, one last question then. I presume you said that the fees, etc., charge will be less out here. But one last question, Samit. Where within this whole pocket of valuation, re-rating, industry leaders, etc., what themes are working out? This is the last question on the show. But what themes are standing out for you right now? If you are, if you can mention, because that would mean that you're seeing earnings visibility in those pockets, those sectors, those businesses.
Right. Right. So, I mean, I will talk to you about the specialty chemical space. I'm not going to repeat that, in detail. But the other themes where there is a lot of earnings visibility is contract manufacturing is definitely one. Whether it's on the the electronic side, the white goods side, or even the pharma and the chemical side, I think that's a really interesting space. On the non-chemical side, I think that's a very small size today. I think which can be 10x in the next 10 years. So that's one space. Another space which I find very interesting is the very niche building materials. So we have spoken about the fabrication pipes, but even within that there are niche, which very high margin products that some small companies are building, which has almost no competition. And if you believe in India that India will be able to attract some manufacturing, India will maybe revert back to some level of mean GDP growth rate. There is infrastructure, there is new factories that will need to be constructed, and there will be demand for such niche where there is not much of a competition. So I think you could, when you do in-depth work on some of these companies, the dominance is very high, way higher than what you'll see in the large cap space between, say, the top consumer companies. Okay. But you are getting these companies at really cheap valuation. And at least over the next 3 to 5 years, there is a tremendous amount of visibility in the earnings.
Yeah. Well, this was interesting, Samit. Fund manager focused on mid caps and small caps, launching a large cap scheme as well, passive as it may be in nature and at lesser fees, but still you've launched one. So that's an interesting one. And it was lovely getting your excerpts and thoughts on how you're playing the market in the current scenario. So thank you so much.
Sure. Yeah. I mean, in the fund management, if you take away the valuation complexity, the work goes down by 90%. I mean, finding out the best quality companies. So we said, we will not do the 90% in the large cap. And people are interested in that, 10% value addition. So, without charging much of fees, that's an offering that we have for those kind of investors who are interested only in the highest quality companies without considering the valuation. But if you're really keen on valuation as well as good quality businesses, we already have the competence in that.
Okay, so remember, viewers, the confidence in mid caps and small caps doesn't die. It's just an alternative that he's putting out. But it was lovely getting a sense of how you're picking up companies in the current scenario. Samit, thank you so much for your time and speaking to us on Talking Point.
Absolutely my pleasure. Thank you so much, Niraj.
And viewers, thanks for tuning into this leg of the Talking Point.